first of all, Arvind, it's a pleasure and an honor to address your class one more time. I think, is this the sixth time you said?
Yes, I think it is, and we're incredibly grateful to you for spending so much time with us over the years.
Okay, no, it helps pass the time, so that's great. Anyway, so our topic for today, at least during the period when I have a monologue going with you guys, is the quest for 10 to 100 baggers. So that's the subject of the talk, and I have a lot of material to cover, and so I'll move this along at a pretty good clip. I think it'll go for at least an hour. It may go a little bit longer, and so maybe you can mute on your end. I think we might get a little bit better audio without the feedback. So for me, the saying that the best way to learn is to teach certainly has held true, and one of the big drivers for me in doing this talk with this particular subject is to learn. And in fact, I learned quite a bit in putting the talk together, and I'm hoping it will be helpful certainly to all of you, but I'm also hoping it's helpful to me in the future. And the reason I chose this topic was because when I first started investing right at the beginning, and I heard about Warren Buffett for the first time in 1994. It's about 22 years ago. And I happened to have about $1 million with me at the time, which was just extra money. First time I had any kind of money of that type in my life. I had sold some assets in my business, and so the $1 million was sitting there. And I'd studied about Buffett and compounding and all of that. And I said, well, why don't we try to figure out whether I can actually do this and invest the $1 million using the principles that I'd learned from Buffett. And of course, at that time, I only had about 12 months of Buffett learning under me, if you will. And so very quickly, I decided that I would basically put the $1 million into 10 stocks, kind of 10% bets, which was very similar to the way Pabrai funds operated later. And but as part of that, group of stocks I wanted to invest in, I was interested at the time in investing in a few stocks in India because a few of them had caught my attention and they looked quite compelling. But at that time in 1994, it was quite cumbersome actually to invest in India, especially as a U.S. citizen and a foreign investor coming into India. And it took a few months to do the paperwork, and then I had to physically go to Mumbai and execute these trades. And then the Indian government at the time had set up a deal where they said that if a foreign person, non-resident Indian, came in to invest in the equity markets, they could repatriate everything back in dollars, and if the gains were long-term, there were no long-term gain taxes. So I would only be taxed in the U.S., which was great, and so I like that. But I was very skeptical whether a country with all these exchange controls would ever actually allow that or actually execute that in a seamless manner. So I had some skepticism about whether investments in India would really be kind of easy to get back to the US and such. So because of those concerns, I limited my investments in India to just $30,000. So out of the $1 million, I only allocated about 3% to India. And the $30,000, half of that went into one company, which is Satyam computers, and which I'll talk about in a second. But I made four investments in India at the time. Satyam was the largest; it was approximately half of the pie, and then the other three, two of them were courier companies, kind of like FedEx and UPS. They were Blue Dart and Skypack Courier, and basically the idea there was that India just had terrible postal service, and if you really needed any kind of reliability in getting packages to destinations, you really didn't or couldn't use the postal system. You had to rely on kind of private companies. So I thought they would do really well as the economy grew. And the fourth company was actually the broker I was using to do all of this. I'd been very impressed with them in dealing with them. Goldman Sachs had taken a 20% stake in them. They were just extremely high quality. So I felt again that their business had some good tailwinds. So I made these four investments, but the broker was kind of a last minute thing. So I think I only invested about $1,500 in the broker, and about 13,000 odd dollars went into the two courier companies. And one of the courier companies was a company called Blue Dart. And when I made the and all of these companies, when I made these investments, at that time India did not have DMAT. So after I bought these shares, I got physical certificates sent to me in California, and these physical certificates looked really beat up, and they looked really dilapidated, and they looked just terrible. They were like falling apart. And so I was very skeptical about my ability to ever get my money back when I looked at these things. But anyway, in 95, I just decided, okay, this is like, buy and hold forever. I stuck it at the bottom drawer of my desk. And I said, we're not going to touch these for a decade or two. Just let them ride. And then what happened is that if you can put up the chart for Satyam computers, I think that's one of the first ones. Let me see what number that is. Give me a second so I can get the same thing going here. Yeah, I think Satyam is the first chart, and these hang on. Yeah, so these charts basically reflect total return. So they include all stock splits, and they also include all dividends. So they don't fully basically reflect exactly what I paid, because Satyam, for example, had a 10-to-1 stock split twice. Once it did a 5-to-1, once it did a 2-to-1. But basically in 95, early 95, I bought the stock for about 40 odd rupees, between 40 and 45 rupees a share. And I noticed that it had gone up a huge amount, because if you can see that in the late 99 and early 2000 period, especially in 2000, it really took off. It was around 2000 rupees from 45 in by the end of 99, about 5 years. And then in 2000, it really took off. And I said, I know I want to hold these things forever. Satyam was a company that I was very familiar with, because I, at the time, was running an IT services company. So I knew the business well, and I obviously was dead center in my circle of competence. But I decided to take another look at detail with its financials to really understand what was going on. When I bought the stock, it was actually trading below the value of the real estate they had in India, and they were growing very rapidly. So the business actually was coming for free. It was very cheap, and a great team and such. And when I studied it, it was trading at more than 100 times earnings. The whole dot-com boom was on at that time. The bubble was on in full bloom, and Satyam had spun out dot-com. And when they spun out that dot-com, they didn't spin it out to shareholders. They had listed a a company which they still held a big share in. That company got a huge valuation, and in return, Satyam's stock price reflected that valuation. So anyway, the stock that I had bought for about 45 rupees was trading at about 7,000 rupees. And of course, the exchange rates had moved against me, but it was still more than 100x. I mean, the 15,000 was sitting at over 1.5 million. It was sitting at a huge number. And again, I opened my desk drawer and I saw those dilapidated certificates, which are now theoretically worth 100 times what I paid for them. And I looked at them with a jaundiced eye because I said, who knows what these are worth? Who knows if they'll ever give me my money, or if I can sell them, or if the money gets stuck in India, or if it gets taxed. I had a lot of variables that I didn't know about. But when I studied Satyam's financials in early 2000, I said, we're getting out of here. We're not interested here, because this is definitely either fully priced or more likely overpriced. And so I contacted the broker and said, I'm ready to sell all my Satyam shares. And so I sent the shares back to them. They sold them all. In fact, I sold within 5% or 10% of the absolute peak price. I was amazed at how close I got to the absolute peak. And then they put the money in my Indian bank account, which was linked to the brokerage account. And then I asked the bank to wire the money to the US, and the next day the money was in my US bank account. And it went through completely seamlessly, exactly as the Indian government has promised. And I had 1.5 million from the 15,000, which was great. Very well done, Mohnish. I felt great. The Buffett thing was working quite well. And of course, I've only told you about 15,000 out of the million. I haven't told you about the 985,000 yet, which we'll get to in a second. And then, these other three stocks that I bought in India, they hadn't done much, because none of the other three were what you would call new economy stocks. I mean, one was a broker, and two were courier companies, very much kind of brick and mortar type businesses. And at that time, many of you maybe were in kindergarten or something, or maybe in first grade perhaps. But at that time, even the day the Nasdaq peaked in March 2000 was the same day that Berkshire hit a multi-year low. Literally, people were pulling their money out of kind of traditional stocks, which they thought were losers, and they were dumping it into pets.com. And they were buying all. It was a frenzy, and it was quite an intense frenzy. In fact, in 22 years of investing, I have never seen a bubble like the .com bubble of 98 to 2000, if you will. And in fact, I remember at the time I was living in Chicago, and I was taking a cab ride in the city, and some Pakistani cab driver says to me in Urdu, "Aapka Cisco ke bare mein kya khayal hai?" And just for the small minority of people who didn't understand that, what he was saying is, "What's your perspective on Cisco?" And when the Pakistani cab driver who doesn't know you, starts talking to you before even saying hello, what do you think about Cisco? You know that you are in the ultimate bubble of bubbles, and it's time to get out. It's kind of like the shoeshine boy in 1929 outside the New York Stock Exchange giving you stock tips. So anyway, the other three stocks hadn't done much. And I held them for like another year. It had been like 6 or 7 years. And then I sent them all to India, and I told the broker, sell them all, because I said that, we had our adventure of investing in Indian stocks. They had the remaining 15,000 was worth somewhere in the 25,000 range. It hadn't gone up much, but hadn't gone down. And one of the stocks, which was Skypack Courier, which is slide number 4, if you just put on, yeah, slide number 4, Arvind, you can see that Skypack Courier actually didn't do much. It just basically fizzled out. And so I lost about half the money I'd invested in Skypack. But so if you go to the previous slide, which is Blue Dart, so I sent these stocks to India to sell, and the broker sold them all, and he said there were just 100 shares of Blue Dart, which they claimed were fake. These were fake shares, they said. So I said, well, if they're fake shares, I bought them from you, so you have, reps and warranties on these fake shares. They said, no, Indian law doesn't give us any reps and warranties to you. This is entirely your fault that you didn't check these shares. So they sent those 100 shares back to me, and but I didn't really care much. It was a kind of worth like, I think the it was worth like $200 or something, and I had cashed out more than 1.5 million, and so I really didn't care much. I just kept those shares, and then just very recently I looked at that stock certificate again about a year back. And I looked at it, I said, this doesn't look fake to me. It looks just like all the other stocks looked. So I contacted the broker again. And by now I had no account or anything with them. Well, I had closed all of that. And a new cast of characters had come in because it had been so long. I didn't tell them they were fake. I just said, I have these 100 shares and I like to sell them. They said, yeah, send them to us. We'll demat them. We'll basically make them electronic and we'll sell them. So I sent it to them and they said, are the shares genuine? They said, yeah, they're genuine. There's no issues. We sell them. So I said, okay, please go ahead and sell them. And when I sold those shares, I think I got, there was a stock split and they gave me $11,000 for those shares. It was like, the original value was, I think, about $100. Sorry, not 200, it was about $100. And it was up 100 times. And accidentally, I had held those Blue Dart shares, even though I didn't intend to, for 21 years. And I've never held any stock for 21 years. So 21 years was truly spectacular. And so I decided to look at, well, what would have happened if I had done, Satyam was clearly a bubble, but there was really no good reason to sell the other 3 stocks. I could have followed the game plan I had originally, which is just leave them alone. And if I had done that with these stocks, Blue Dart eventually was a 60x. I think it was $200. The 200 went to 10,000. Sorry. So Blue Dart, if I had held it all the way through, was 60x. Kotak Mahindra Bank, which is, I think, the next slide. Slide number 5. Kotak Mahindra Bank ended up being a 50x. And of course, Skypack, we lost about half our money. So, I was thinking about this. I said, well, the other 15,000, there were some real winners in them. I mean, I had about, I think in Blue Dart, I'd invested $7,700 in Blue Dart, and today that would have been worth $465,000, which is not exactly chump change. And the Kotak investment, which was the smallest, that was 1,500. That would be 75,000 today. And so while I certainly benefited from a bubble, and I was able to it had a good positive impact on my net worth to capture that. It got me thinking, because then the second part of it is the other 985,000. In the other 985,000, if you go to actually, I'm not sure where I put this slide. Let me just see if I can find it. I think this is slide number 8. So Arvind, if you can go to slide number 8. So the other 985,000, one of the stocks I invested in was CMGI, which was basically, that was a deliberate bet I made where I was in the tech industry, and clearly the internet you looked like it would be transformational, but almost everything was trading at ridiculous multiples. But when I found CMGI, it was a kind of a incubator. Actually, it was based in the suburbs of Boston. Um, it was an incubator, and it was kind of spawning out or investing in a bunch of dot coms by the dozen, if you will. And the stock at that time was still very much benign, just little premium to book. And so I put 10% of the million into CMGI, and I eventually cashed out at about 100 times what I put into it. So the 100,000 that went into CMGI turned into 10 million, and of course we saw that the 30,000 in India turned into north of 1.5 million, and the rest of the portfolio, the remaining 900 or 870,000, if you will, at that time the stock market has gone up in the kind of the 25% a year range for that 95 to 2000 period, and so the rest of it had doubled or tripled. So the overall result of the portfolio was more than acceptable. I mean, it had gone up to something, 13 million or something, 13, 14 million, somewhere around that number. And so, I said, good job, Mohnish, that was fantastic. This is amazing. But, the experience at Blue Dart um, got me thinking that I've always been the kind of investor who buys things hopefully for 50 cents or less on the dollar, and attempts to sell them when they get valued at 90% or more what they're worth. So if something's worth a dollar and it's available for 50 cents, very happy to buy it. And then when it gets to 90 cents or better, I'm happy to sell it. And I'm assuming that most of the time that convergence from 50 cents to 90 cents happens within 2 or 3 years. And if it happens within 2 years, you end up with a 30+% return. And even in 3 years, you'll end up with a kind of low to mid 20s type return, which is very acceptable. And so that is the modus operandi I've followed for more than 2 decades. And so one of the reasons for this talk is that I realized that uh, my approach is flawed, because while the doubles and all of that certainly work, um, you know, I think like Charlie Munger one time told me that for each of us there is a limited quota of truly great businesses which have the ability to generate spectacular returns for us, 10 baggers, 50 baggers, 100 baggers, uh, while holding it for a long time. And the important thing for us to do is to do nothing, is to recognize when we have something something like that in our portfolios, and not be in a hurry to act. And so I thought about the experience at Blue Dart and these companies. I said, well, how many times has it happened in my portfolio that some huge multi-bagger showed up? I was smart enough to buy it, uh, but perhaps not smart enough to keep it. And I realized it happened a lot, because when I went back and looked, I found this happened several times where I made a double or a triple or a 4x, and I sold, and the stock went up 10 times after that, for example. And so I said, well, what can I do in terms of a framework to be better at identifying? Because the advantages that you get I don't need to really spend too much time explaining to you guys that 100 baggers are really good for your health. And not only are they really good for your health, um, you have no taxes for a long time. So you have deferred taxes, free loan from Uncle Sam for the entire period you own the stock. It kind of almost becomes like investing in a retirement account, because if you can hold something for 10 or 20 years or 30 years and then pay a tax bill one time, well, that's very highly efficient. So not only are the multi-baggers great from just a pure numbers perspective, they have a significant upside in terms of taxes. And I live in perhaps one of the highest tax states uh, in the country, where while the federal government gives me a break on long-term gains, the state of California doesn't. So the marginal tax rate for someone like me in the state of California is north of 12%. And so while the federal long-term gains may be 20 or 22%, California is more than half of that. And so it's really good for your health if you're in California, to get the free loan for a long time. And so I thought about, is there a framework, and is there a pattern to these different stocks? And what I realized as I went through it is that, yes, there is a framework. I've never seen the framework before presented anywhere. And so I said, well, since nobody wants to do it, might as well be Mohnish, and it might as well be the good students at BC who get to hear and learn about the framework. Um, so by the time it was time for this talk, because Arvind didn't give me too much time, I came up with 5 different attributes in terms of kind of 5 different kinds of businesses that can be huge multi-baggers. They fall into kind of 5 different categories, and there well may be more than 5 categories. And if Arvind invites me back next year, and if I've come up with some more, then your successors, I'll have them watch this video and I can give them any more that I come up with. But these 5 feel like a good framework, and I wish I had this framework 21 or 22 years ago, because if I had this framework, I would have taken different decisions. And while the journey has been very, very good for the last 2 decades, it would probably have been better, significantly better. And so let me go through the framework. So there are 5 different kind of categories of businesses that we should kind of pay attention to, because they have the potential to have huge multi-bagger gains in the long run. So the first kind of business is a business which has extremely wide and deep moats. And these businesses are so good that idiots can run them. So their core economics are so fantastic that they're almost indestructible. And in fact, if you see some of the examples of some of these businesses, they have been run by idiots. In some cases, they've been run by idiots for decades, and they couldn't destroy the business. It was so good. And so I have hardly ever had the good fortune of having these types of businesses in my portfolio. And one of the reasons they don't end up in my portfolio is because I'm a cheapskate. Usually I'm going for the bargain bin and trying to find things that are 50 cents off and there's some anomaly and something. And these types of businesses usually they'll sometimes get to the bargain bin, but they usually don't get that cheap. And so what are some examples of these businesses? Well, some examples of these wide moat businesses runnable by idiots are businesses like Coca-Cola, See's Candy, Moody's, Visa, MasterCard, American Express, and so on. And so if you clearly many of us are familiar with Coca-Cola, for example. And of course, we studied Coke with Arvind's other class, and maybe he can share some of those results with you. But Coke is a business that has basically been growing nonstop for something like 1.25 century. It's been a long time, and it continues on a non-stop growth path, which will go on for a while. And there's a talk I gave uh, to the students at UC Irvine, and some of you may have seen that talk, but it's on YouTube. So if you get a chance to see that sometime and you can't go to sleep at night or something, you can take a look at that talk, and it explains uh, the incredible business model that is Coca-Cola, and that will give you a sense. So sometimes, uh, and Coke was a business that was for decades run by very poor managers, and even though they were run by managers that were not so good, um, the business kept going. They really couldn't do much to destroy it because the economics was so good. And Moody's is another example of a business that is exceptional because, let's say some company is issuing some bonds and they need a credit rating on their debt in order to, give investors comfort. Well, there are only a couple of places, two or three places they can go to. Usually they have to go to Moody's or S&P in the US to get that rating. And Moody's and S&P usually charges them, an arm and a leg. It's usually, you know, uh, probably 10 or 20 times or 30 times what it costs Moody's to do the analysis and give the rating. So Moody's may have an analyst who they're paying very well, maybe 100, 200,000 or something like that. That analyst is probably going to bring in several $1 million in revenue because he'll be rating several companies which will be issuing debt over time. So, it is a great business if you pay someone 200,000 and he brings in 5 million of revenue every year. And it's a great business when the companies have to keep coming back to you because the number of debt instruments dwarfs the number of equity instruments. I mean, if we have 5,000 stocks in the US, we probably have more than 50,000 different types of rated debt instruments. It may be even well beyond that. It may be several 100,000. So each one of those instruments is separately rated, and each one of those generates fees for companies like Moody's. And Moody's is a company, and same with S&P, which we saw in the financial crisis, um, delivered outright incorrect and blatantly wrong ratings on all these mortgages and everything else, where they rated them AAA and they probably were just horrible. They were prone to have high defaults, and they did have high defaults. Even after doing that, that's the only competency they need to have, which is rate the quality of debt. Even when they couldn't do that in the financial crisis, you still could destroy the company. And actually, if we go back and look at the Moody's stock chart in slide number 6, you can see that in the 2008, 09, and 10 period, the stock came down a lot. And in fact, if I hadn't been staring at my belly button, I should have bought some. And at that time, basically you saw that there was a very strong effort made by various regulators and Congress and such to punish Moody's and S&P. So it caused an overhang on their stock prices, and they made them pay some fine. But you can also see that none of that affected the business. I mean, the all-time high for Moody's in 2007 was around $60 a share, and now it's approaching twice that. So whatever they did in the financial crisis, which they were a very critical piece, they were not the only piece, they were a very critical piece of fueling the fire, if you will. Without the Moody's and S&P ratings, you would not have the pervasiveness and extensiveness of damage that happened to the global economy. And in spite of being such a critical contributor to such a major crisis, here we are with an idiot-run company still doing great. And so the next time it has a problem, I will not be navel grazing. I will be calling my broker. And I have a friend of mine, Guy Spear. Some of you might have heard of him. And sometimes in my conversations with Guy, I like to put salt on old wounds just to see how he reacts. And so Guy has a mental model where he says, look, if you can identify a great business in the United States, like let's say if you say Coca-Cola is a great business or Coca-Cola bottlers are a great business, then you ought to go look for bottlers in other parts of the world which are also bottling Coca-Cola because they probably have very similar economics. And Coke is a great business. Being a Coca-Cola bottler is not as great as being being Coca-Cola, but it's still a really good business. If you inherited a Coca-Cola bottling operation or a Pepsi bottling operation, you will never have any financial issues in your life. Trust me, everything's going to go great because those are great businesses. So he said, well, we should go look for Coke bottlers in Turkey. We should look for them in Africa. We should look for them in Brazil, in China, in India, and we should basically see. Guy's model was see what the valuations are in all those different markets, because in other markets they may or may not have realized that this is a great business. And sometimes what can happen is that, let's say, for example, the Brazilian economy is doing poorly, the stock market goes down, well, everything goes down, including the Coke bottler. And so sometimes you might be able to pick up a Coke bottler in Brazil for a lot lower price than the Coke bottler in Tennessee, for example. And so he's done this quite successfully. So he loved Moody's. He did not like the stock price. And so he said, well, what other credit rating agencies are there in the rest of the world which are providing this critical function in different countries? And they all must have similar economics to Moody's. So which ones are out there? And he did a global search. And if you go to slide number 7, he identified a company in India called CRISIL. And Guy invested in CRISIL. So in 2001 or 2002, he bought some CRISIL. At that time, I think he was running 30 or 40 million, and it was a small investment. And then it went up, it doubled or something. And then he added some more in 2004 or 2005. And then, he got 2 or 3 times his money in a couple of years, and then he exited. And all I got to do when I want to sprinkle salt on Guy's wounds is say, Guy, that CRISIL position that you had, that you were so smart to buy in 2002 and 2005, do you know what that's worth today? He said, why do you have to bring that up, Mohnish? And I said, no, have you looked at what it's worth today? And I said, maybe you haven't, so I have the exact number for you. And basically, CRISIL basically, on the 2001 purchase that Guy did, it's gone up 200 times since then. And on the 2005 purchase that he did, it's gone up 43 times. And he manages around 160 million. The CRISIL position alone in his portfolio, if he had not touched it, would be probably close to 150 or 160 million. So it would be 50% of the pie instead of being 0% of the pie. And what was so difficult, especially after I give you this framework about knowing that it's a great business. Now, if you had any doubts about CRISIL, in 97, in 1997, 1998, McGraw-Hill, which was the owner of S&P, paid $8.5 million to CRISIL for a 10% stake. So they, just like Kotak Mahindra Bank Goldman Sachs had taken a stake. So if you were looking for a strategic investor from the US who had blessed CRISIL as being a high quality operation, you couldn't get higher quality than S&P taking a stake. And what S&P kept doing is every few years they would buy an additional stake. They would convince the CRISIL people to sell them a little more. And I think now S&P owns 75% of CRISIL. So they've taken that stake and they've paid a lot more over the years. So the $8.5 million stake in 97 and 98, the market cap of CRISIL was 85 million. The market cap of CRISIL now is 25 billion. And I believe when you look at the stock chart of CRISIL, and I'm talking to you here, and I'm sure I'm going to regret this when I watch this video 10 years from now. It's probably a mistake if I owned it to sell it today. Because as far as emerging markets go, and as far as the debt instruments, the size of the instruments, the number of instruments, 10 years from now, 20 years from now, 50 years from now in India will dwarf the number today. Now, if you look at the CRISIL nosebleed price earnings ratio today, you're going to take a pause. But it may well be, because the quality of the business, that nosebleed valuation may not look so nosebleed 5 or 10 years or 15 years from now. So these are the ultimates. These are the businesses that, if they ever show up in our portfolio, what I've learned from this is, if they have this characteristic of incredible moats. I mean, if you look at Moody's, if the 2008 financial crisis could not destroy the moat, nothing is going to destroy the moat. That is the biggest seismic event they could ever face in 100 years. I don't believe in the next 100 years they will face anything like the event they faced in 2008, because that was really getting at the core. I mean, that's almost the equivalent of Coke selling poison product. They were selling poisoned ratings, and they still survived. So these are the ones to watch for, because they've got incredible economics, and these businesses with incredible economics will just blow your mind in terms of what they can deliver. The second kind of business, so we've crossed off the first one. The second kind of business is exactly like the first one, except that they cannot be run by idiots. They actually need competent humans to run them. So these are, again, great businesses and great franchises, but they need to be run by great managers. And so what are the businesses that fall in this category? Well, they are Amazon, Costco, Geico, Kotak Mahindra Bank, Blue Dart, Satyam, Restaurant Brands International, the guys who own Burger King and Tim Hortons, Yum Brands, Domino's Pizza, and so on. So these are businesses that have incredible economics. I mean, if you own Marriott International, which owns all these different hotel brand names, the number of hotels Marriott actually owns is less than 1%, or probably way less than 1% of the number of hotels that they have their brand on. So they don't have the investment in the real estate or any of the capex associated with that hotel. But each time someone checks in, a portion of that night stay and the revenue generated comes to Marriott. So Marriott International, also a great business, but it does need competent management. So these businesses are more prevalent in the marketplace than the first category. The first category is a very unusual category. I mean, you would be looking at beer companies, you'd be looking at tobacco companies in the first category. I mean, the human vices would show up in the first category because humans get addicted to these things, and then you'd be looking at, the Costco, the Coca-Cola, the Moody's. The second category is a little broader because you do need management to be competent, and the moats are not quite as robust, but they're still pretty solid. And I haven't had much in terms of the second category. If I look at my portfolio, I did have three of them: uh, Kotak, Mahindra, Blue Dart, and Satyam, that were part of my portfolio. And I was not smart enough in two out of the three of them to keep them around. So one of the reasons to do this talk is to just pound that into my head. Um, you know, the best thing to do is take an afternoon nap, not put a sell order in. And I know Arvind has disappeared towards the side, but Arvind, I had a great nap before this class started, so I'm in great shape. Um, anyway, the going on to the next category, and this category has shown up the most frequently in my portfolio, and this is the one where I've had the most difficulty, where I have not been able to capture in many cases the significant upside. So this third category is a category where I call markets getting confused between risk and uncertainty. And so I'll give you a few examples. And the first example is a company called IPSCO. And so IPSCO is a steel maker. And we can go to the slide on IPSCO. Let me see if I can. Yeah, so slide number 9. And so IPSCO sits in the center of the North American continent in Canada, just above the Great Lakes. And they make basically plate steel and tubular steel. The company doesn't exist anymore. They were bought by a Swedish company, I think in 2007, and that's when they stopped trading. But when I found the company in 2005, they were trading for, the economics were like this. IPSCO had a market cap of 2.5 billion. They had 900 million in cash on their balance sheet. They had given guidance that the next couple of years with their backlogs and such, that they had approximately 650 million in cash flows coming in terms of net income in the next couple of years. And then there was no visibility beyond the next 2 years. And so the markets kind of don't like uncertainty. So, but my perspective was that who cares what happens after 2 years? If you take the 900 million plus the 1.3 billion in the next 2 years, you've got 2.2 billion, and the market cap is 2.5 billion. So I said, okay, what I'm going to do is I'm just going to own this stock for 2 years, let this cash balance get to 2.2 billion, and then I want to see what the company's trading at. And I didn't think it was possible they would trade at 2.5 billion at the time, because you got all the plant and equipment and everything else that they got. And of course, the steel business is very cyclical. So, but I felt that the upside downside ratios were out of whack. And so a year went by, and so you can see in the beginning of 2005, it's in the 40 odd dollar range. And then by the time 2006 arrived, they had visibility into another year of around 650 million. And so by now the stock had climbed, it had gotten up to close to $100 a share, and was bouncing around between kind of 80 and 100. And so I said, well, now we are at a point where we've got close to 2 billion in cash flows plus the 900 million. We're above our cost basis in terms of cash coming in. And so I said, let's continue holding the company, because we don't know what happens in after 2007. And then in early 2007, they got a buyout offer from this Swedish company for $160 a share or thereabouts, maybe around 165 or so. And so the stock went up like 157 or something. And I decided that was enough. and I unloaded. So in this particular case, actually, we captured almost all of uh, the upside that was associated. And the funny thing about the way the world works is this Swedish company came in the early part of 2007 to buy the business. They could have shown up 2 or 3 years before that, and they could have bought it for one-fourth of that, right? And clearly, they were people who I hope who understood valuations of steel companies, and but they didn't. And that's one of the kind of crazy things about the way the world works is neither did they show up, nor did the market have much respect for companies with volatile earnings. So the risk with IPSCO that I saw was very low, but the uncertainty with IPSCO was relatively high. It was extremely uncertain after 2 years. And one of the things I think probably the markets were concerned about is, could the company actually lose money, for example? I mean, what would happen if they had a severe downturn and so on? So, but I felt that the asymmetry of the risk reward was very lopsided, and so looking for these types of opportunities is kind of interesting and can be profitable. And there's a company in my portfolio right now, which is Fiat Chrysler automobiles, another hated industry, high capex, subject to consumer tastes, unionized, all kinds of good stuff. So Fiat Chrysler is a company that has a market cap of less than 10 billion, about 9 billion or so, 9.5 billion. And they have said that in 2018 they expect earnings per share to be north of $5.50 a share. So which is about 7 billion or something. So you have a market cap of less than 10 billion, or let me put it in stock price. The stock price is at under $7, and the 2018 earnings are suggested by the company to be $5.50. So if they actually deliver $5.50 in earnings in 2018, this would be trading at I don't know, 1.3 times. It's a PE of 1.3. So I'm missing my friend Arvind, who's disappeared to the slide. Arvind, you can come back into the scene for a second so I can see you and ask you a question. But how many stocks are there in the US that trade for less than 1.5 times earnings? Since you have all these resources at Fidelity.
I don't imagine that there are many. I'd be curious to hear how much debt the company has, though.
Yeah, so I'll get to that. I'll get to that in a second. Maybe you can mute the microphone. Sorry about that. But yeah, so the company has guided. It's also guided that it will be debt free in 2018. Actually, so they will have debt, but their cash balance will exceed the debt. And in fact, this year, for example, at the end of this year, the end of 2016, they've guided that the net debt of the business will be like 5 billion, less than 5 billion. So here's the situation. If I pull up Value Line, which is tracking 1,700 companies, and I look at the lowest PE companies in Value Line, usually there will be one business or maybe two businesses that are less than a PE of 2. I think recently when I looked, I think there was only one business. Um, so businesses less than a 1 or 2 PE is well under 1/10 of 1%. And Value Line is not tracking the average stocks in the US. It's tracking the better 1,700 stocks, if you will, in the US. So if I look at Fiat, for example, and I pull up any brokerage report on Fiat, and the street research, if you will, and I look at their 2018 numbers. So the Fiat management says EBIT, earnings before interest and taxes, will exceed 9 billion euros in 2018. And in the brokerage reports, they have 2018 EBIT at 3 billion. Okay. And so there is like a 3-to-1 difference between what the street seems to believe and what the company is saying. And my analysis suggests that the company is not exactly high on various substances when they're making such a claim. And so just like IPSCO, my take is set it and forget it, which is okay, we don't need to kind of scratch our heads about this too much. We own the stock. We're not going to do anything with it. We're going to wait till probably the first quarter of 2019 when the 2018 numbers are published. And if Arvind invites me back in 2019, I'll share with you what happened and see what's going on. So I realized when I was preparing this talk that I never correlated the similarity between IPSCO and Fiat Chrysler. And when I was preparing this, I said, oh my God, this is kind of why I like this, because it brings me back to the very nice memories of the wonderful people at IPSCO. And
Mohnish, just a question on that. With IPSCO, it sounds like you had a backlog that gave you comfort with the cash flow. What's the parallel here?
So the parallel here is, number one, I have a man crush on the CEO, Sergio Marchionne. If my wife allowed me, I would take him on a date. I don't think she's quite ready for that yet. And I don't know whether Sergio would go on a date with me, but it'd be a fun date. So first of all, I love Sergio. And the second is I've actually looked at how they've come up with the numbers. And they didn't just come up with a number, they actually gave a lot of detail. So if you go on the Fiat Chrysler website, so first of all, I don't want this to be a stock tip, right? The class is not about a stock tip. And clearly, please, if you take any actions, you are 100% responsible for those actions. Just don't come to me because there's no reps and warranties here. Because, I already told you I have the man crush, which is clouding my vision. And so anyway, if you go on the company's website, they have a 5-year plan, which they gave out. They had an investor day in 2014 where they laid out their plan from 2014 to 2018. And they've updated the plan a couple of times since then. So they did an update in September of this year. They did another update about a year ago. And so they actually give you the pieces of how they get to that number. And those pieces are so far, I mean, they've got 2 years left, basically. They've delivered. They've delivered on the first 3 years of the plan in spades. They are pretty much exactly where they thought they wanted to be. And one of the things that Sergio does, he's a great manager, is he sets these stretch targets to push his team. And it clearly was a stretch target, but it was a public stretch target. And he intended to deliver on the public stretch target, and he thought about it. And they've made some they made some tweaks to the plan as they've progressed. So, for example, one of the things they realized since 2014 is that the world loves Jeeps a lot more than they thought they did in 2014. And so they have, so just to give you an example of what one of the things that's happening is in 2009, when Fiat bought Chrysler, Chrysler produced about 250,000 Jeeps a year. And this year, I think they're going to produce close to 1.4 million Jeeps. So the Jeep production at Fiat Chrysler used to be, it was only produced in the US. It is now produced in US, Mexico, Brazil, Italy, and China. So they're producing on every continent now, and they're just the Chinese Jeeps are over 100,000 run rate now, and they just started making the Jeeps in China. And China's projected to be in 2018 500,000 Jeeps, and I believe they'll get there because the Chinese love their Jeeps. I actually think that the $5.50 from the way things are going right now is a low ball target. I think they'll blow through that. They might be at $6.50, so it actually truly be a PE of 1. And so anyway,
Thanks, Mohnish. We don't want you to have any commitment or consistency biases, so don't.
Yes.
Yeah.
So let's move on. Okay, so the next one we want to talk about is Tesoro Petroleum, and Tesoro. This is slide number 10, and so I made the investment in Tesoro in the middle of 2002, and basically. The reason I bought Tesoro was that the stock price had been cut by 75%. It was at $30 a share and gone down to $7.50. And one of the reasons it went down to $7.50 is that the company had purchased a oil refinery, and they had loaded a lot of debt on their balance sheet to make that purchase. And after they had completed that purchase, the crack spread, which is the spread between the price of gasoline and the price of crude oil, if you will, the crack spread had narrowed a lot, and so their cash flows were stressed, and the markets were very concerned with all the debt and so on. And so just to step back a little bit on the oil refining business, in 30 years, the United States has not built a new oil refinery. And the reason we haven't built a new oil refinery is because of NIMBY, not in my backyard. Nobody wants nuclear plants in the backyards, and nobody wants oil refineries in the backyard. So getting permitted to open an oil refinery in the US is almost impossible. And so what happens is that the existing refineries, they keep tweaking those refineries to get more output out of them. And so oil refining, because of this attribute, is actually not exactly a commodity business. Of course, refined oil can come in from outside the US, but also what happens in the US is that the formulations that are required for each of the states is usually different from the other states. And so you cannot just produce gasoline in the US and sell it across the US. California has a set of very stringent requirements. Illinois has ethanol requirements and so on. So all the states require, they require different blends. And so refineries are kind of optimized creatures. Some can produce some blends, they can't produce others. Some can deal with sour crude oil from like Saudi Arabia, others can't, and so on. So the inputs and the outputs make each refinery kind of a creature of its own, if you will. So suddenly, for example, if you had a high crack spread on the kind of oil refined gasoline you need in Hawaii, you may or may not be able to supply that from other refineries in the US because they cannot adjust that quickly to that. And so my take on Tesoro was that they had a bunch of refineries. And I felt that if the debt was an issue and if there was a real concern there, they could unload assets and they could unload refineries. Refineries are kind of standalone entities, and they, just like the refinery they had bought, now they may be selling at distressed prices. But also, when I looked carefully at their financials and their covenants, and then when their debt was coming due, I think the market, I think, was overreacting to their debt situation and such. So after I bought Tesoro at 750, it proceeded to go down to $1.33 in price. So, Pabrai funds put 10% of assets into Tesoro at 750, thinking this is extremely good. Mohnish, you've done your homework, it's great. And then we were down 80% after that. And of course, when we're down 80%, one of the things that I'm very used to is everything I buy goes down. So that's just normal. But that only happens to me. It never happens to Arvind, and it never happens to anyone else. It only happens to me. And so when it's at $1.33, I'm looking at everything, looks fine and such. I say, okay, we got to kind of hang in there. We just don't have much choice here. We're not going to sell this thing because we're going to let this thing play out. And then it got back to 750, which felt really good. And then it got to $15, which felt even better. And I said, we're out of here. We got our double. This is a cyclical business. We're out of here. And so I sold Tesoro. We made 100% return. And when I bought Tesoro, they had a $480 million market cap, and I estimated the value of the business was over $1 billion. That 480 million market cap went down to 85 million a few months after I bought it. The current market cap is 10 billion. Plus, they did a $6 billion spin-off, which is Tesoro Logistics, the next slide. So they spun off this brand new company, Tesoro Logistics. That has a $6 billion market cap. And they issued another 700 million in dividends between 2002 and now. So actually the dividends that they've issued in the last 13 years exceeded the market cap when I bought the business. So from the absolute bottom tick that Tesoro hit, the $1.33, it's a 200x. And even at the $500 million price I bought, it's more than a 30x. And again, the thing with what I did not appreciate about Tesoro is again a business just like IPSCO. It's a very cyclical business. But what I did not appreciate is there was a very gifted manager, Bruce Smith. And I could tell every conference call I listened to Bruce, I wasn't quite as much in love with him as Sergio, but I love Bruce. And Bruce was an exceptional manager and did a great job. And he, during the financial crisis, for example, he bought up all these pipeline assets and built up the business and so on. And he was really, really good about the way he managed the business, managed the cash flows, and managed all the different operations. And he was very heavily responsible for that huge home run. So again, a low risk, high uncertainty, Tesoro would have been good to hold for a while. Then going to the next one, which is Frontline. And so Frontline is a shipping company. And this is slide number 12. And so here the mistake I made with Frontline. Now we made money on Frontline. So what I did is, let me just give you a little bit of an insight on Frontline. Basically, they are at least at the time I invested in them. I think this was in 2002. They were a leaser of a very large crude carrier. So the VLCCs at that time, these are the kind of these large ships that transport crude from Saudi Arabia to the U.S., etc. And the global fleet at that time of very large crude carriers was 400, and Frontline had about 70 of them. So they had 70 out of the 400 global fleet. And these VLCCs get leased out in two different ways. They either go on time charters where some oil company or company will lease them for several years at a time, or they go out on like kind of daily charters where they're on the spot price. So it just depends on whatever the price is. And if they go on daily charters, the price range on the daily rental rates on these VLCCs is extremely volatile. On the low end, it has gone down as low as $5,000 or $6,000 a day, which is when they're losing money. They're just covering marginal costs, if you will, and it's gone all the way up to 300,000 plus per day. So the range of the what you would get in terms of the spot price on VLCCs is 100 to 1, almost no, let's say 60 to 1. From 5,000 to 300,000. And once the rate is more than 30,000 a day, for example, the company is making a lot of money. Once it goes to 40 or 50,000 a day, it is in supernormal profit territory. And once it's making over 100,000 a day, they are just drowning in dollars, if you will. It's just huge. And so one way to value a company like Frontline is to try to estimate the cash flows, which is very hard to do. The second way to value Frontline is to look at liquidation value of the company. So these VLCCs get bought and sold all the time. And so you can track what the pricing is on a VLCC based on age and all these different things. And so Frontline's liquidation value was around $9 a share, and it was $9 a share with the drop that VLCC prices had undergone when these rates had gone to 10 or 12,000 a day. So the stock was at about $6. The liquidation value is about $9. I thought I'd capture that spread between $6 and $9. And their debt on these VLCCs was at the ship level. So each individual ship had leverage on that ship, kind of like a mortgage on a particular house. So if there are any problems, all that the lender could do, they could repossess the ship. There was nothing else they could do. So most of the debt was at the ship level. And so I said, well, if there's an issue with the company, they can just liquidate the fleet. And even if they liquidate at a discount, it would still be over $6 a share. So the market didn't like the uncertainty, so that really collapsed the stock price. So one of the things about the VLCC market is that when these rates collapse, like let's say they go down to $5,000 or $10,000 a day, well, what happens at that time is ship owners, especially of the very old VLCCs that are, let's say, 15 or 20 years old, 25 years old, the rust buckets, they prefer to scrap them. Because when they scrap the ship, they'll get 10 to 20% of the original purchase price of the ship immediately. And so they're losing money on the ships with having the crews and all that. So they'd rather just get rid of the ships. So one of the things about the shipping business, because it's dominated by these flamboyant Greek guys, is they project present circumstances to infinity. In fact, most investors project present circumstances to infinity. So when VLCC prices are $100,000 per day, they believe it'll always be $100,000 a day. When it's $5,000 a day, they are crying in their bars, into their beers, and they think it'll always be $5,000 a day. And so they project present circumstances to infinity. The other thing that happens with the VLCC business is that it takes 3 or 4 years to build one. So when the shipping rates are at 100,000 per day, all the Greek ship owners go to the Korean shipyards and place a huge number of orders for ships because they believe what could go wrong. You take these ships, it costs you 20,000 a day to run them. Joe idiot Joe is paying you 100,000 a day, you're just going to make, found money. It's going to be, and the 20,000 per day, you're getting cheap bank financing and all that. So they put up small deposits. So each of these ships cost like 70 million, 80 million or so. They'll put up a $2 million deposit, and the Korean shipyard will put them in a kind of queue to build the ship. And then when they're ready to construct the ship, they'll say, okay, now, send another 5 million and, start making the payments. And of course, by that time, those 100,000 per day prices may not exist. And so then they won't even return the shipyard's call. They'll say, let the deposit go. We don't want the ships. So they place a lot of orders when the rates are high, and they place no orders when the rates are low. So you have these boom and bust cycles because it takes 4 years to build these ships. So all the extra ships show up at the same time. And when those extra ships show up, rates collapse. Then nobody orders ships for a long time. They scrap the old ships. As the old ships get scrapped, it sets up the conditions for another boom. And then they again place orders. So this continuous boom and bust cycles in the shipping business is a norm. It's just like the Class A office buildings in prime US cities, if you will, because of that 3 or 4 year lag. And because humans are involved in the decision making, and because humans vacillate between fear and greed. So anyway, the bottom line is when shipping rates go to 10,000 a day or 5,000 a day, those rates set up the conditions to spike to 100,000 a day. Because what happens is a lot of ships get taken out and get scrapped. And then when the oil demand comes back up, the ships aren't there. They can't manufacture ships that quickly. And so the only thing that can move is the price. And so this was an attribute I did not appreciate about Frontline. I just took the in and out. Now, if I had kept Frontline all the way through, and I had sold, including the drop in price, because they had all the dividends. I bought the shares for $6. They issued $56 in dividends. Then they spun out a company called Ship Finance, and that issued $24 in dividends. Then Ship Finance stock price is $14. The end to end is my $5 or $6 purchase price. I would have ended up with $130, almost 25 times if I just, and that's including the current collapse in the shipping industry. And in fact, one of the things that happened when I was preparing this talk is I realized that today the shipping industry is in the doldrums, just like the VLCCs were in 2002. And so I said, well, it means that, again, with the risk and uncertainty, there must be some slivers of that market that may be interesting. And I actually recently just found one. I'm still studying it, but it has exactly these attributes. And this time when I make the investment, if I make the investment, I won't be stupid like last time. We're gonna ride it beyond liquidation value, if you will. So,
Mohnish, wasn't there also the move from single hull to double hull when you invested, which added a regulatory tailwind?
Yeah.
After, Exxon Valdez.
Yeah. So just to go back to before any of you were born, this drunk captain on the Exxon Valdez off the coast of Alaska, kind of runs aground and then spilled several million gallons of crude on Prudhoe Bay and destroyed quite a bit of habitat. It was terrible, one of the worst natural disasters. And of course, Exxon is still paying out for that. And so there were a lot of changes that took place after that. And that was a VLCC that leaked those huge number of barrels. I mean, this is way worse. The Exxon disaster was far worse than the Gulf disaster with the broken oil well, with the what are the name of that the rig on the off Louisiana? I forget the name. But anyway, this is.
My
I'm
TA
sorry.
Troy is saying Horizon.
That's right. It was much worse than Deep Horizon. So anyway, what they did, one of the rules they came up with at the time, they mandated that all these VLCCs have to be double hulled. So after the Exxon disaster in '92, they mandated that everything has to be double hulled, and so over time the single hull fleet has been scrapped. But what started happening a few years after the Exxon disaster is U.S. oil companies did not want the liability risk of bringing in single hull crude carriers to the U.S. So what happened after a few of the double hull ships started coming out is the single hull ships mostly got used to transport crude to third world countries, Africa, India, Asia, and so on. And most of the crude transported to Europe and the U.S. was double hull. So you got a caste system in the crude transport system. But when the shipping rates collapse, when they go, so single hull ships will always rent for 5,000 a day less or 7,000 a day less than the double hulls. But when the rate is down to 7,000, then the single hulls stop getting rented at all, because there's no reason to rent them because you can get a double hull for 7,000, and so the single hulls go through very aggressive scrapping. So that actually accelerates the scrapping. And so one of the things about the attribute of the business was that at that time, because of the collapse in rates, the amount of scrapping of ships was on a turbo path. And that set up the conditions for the subsequent massive pop in price, if you will. And so anyway, going on to the next one, which is Teck Cominco. So we'll go to which is called Teck's Resources, slide 15. At the time, it was called Teck Cominco. And this was one I missed because the same thing happened earlier this year, actually. But during the financial crisis, or just before the financial crisis, in like kind of mid 2008, Teck Cominco had completed a large acquisition of a metallurgical coal mining operation, and they had taken on a huge amount of debt to complete that acquisition, and they took the debt on as a bridge loan to get the deal done, and then they were planning in 1 year to kind of refinance everything and get the balance sheet kind of back on track. And of course, what happened is that right after they closed the deal, the world went to hell, and Lehman Brothers happened and all of that. And so Teck Cominco is like kind of like the IBM of mining companies. It's really a blue chip company, really well run, and they've got some of the lowest cost mines around the world. And they've got a lot of iron ore, metallurgical coal, zinc mines, and so on. And so the stock price for Teck Resources went from $45 a share to $4 a share in a very short period, like 12 weeks, 10 or 12 weeks. It collapsed because this was a stock that was usually a safe kind of widow's kind of stock, if you will. And so it didn't really have a natural constituency of people who wanted to own it because of this huge overhang. And when I looked at Teck, it was very similar to Tesoro, where I said that no, they do have stress on their balance sheet, and they do have cash flow issues, but they also had these ultra low cost mines, and they had some hedges. And so my thinking was that the banks who had all this bridge loan debt would not want to run a mining company and would not want to liquidate this company. What they would probably do is they would do extend and pretend, which is they would extract a pound of flesh and push out their loans. And my sense was Teck could sell some assets and they could get out of the kind of the fix they were in. And that's actually what they did. So I invested at about less than $5 a share. And this was at that time, there was a lot of commodity stocks available. This was part of a basket. So I made a 2% bet on Teck Cominco, and I made 2% bets on several of these commodity plays because they all collapsed in price. And in fact, we had no losers amongst all of them. All of them actually did very well. And a few months, I think just 2 months after we bought, a strategic Chinese investor came in and bought a stake in Teck Cominco gave them cash, which took away some of the risk. And then they renegotiated with the banks, they sold some assets, and then commodity prices started to come back up. And eventually it went to around $35 a share. We had a 7x in a year, and we sold. And then it went to $55 a share. So at least in this case, we captured most of it. But very recently, it went down at the beginning of this year because commodity prices had again collapsed so much to less than $5 a share. And I wasn't paying attention. And I saw it taking place, but I was looking at other things at the time. And so that was a glaring mistake or omission. Because I'm sure that if I had studied the business and the balance sheet and all of that, I could have gotten a better handle of what was the dynamics at this point. And again, it's driven by fear and greed, where humans just don't like the uncertainty. But when you get these kind of risk and uncertainty things going on at the same time, you can get kind of wide distortions. And so that's the fourth. So that's the third kind, which is this high risk, low uncertainty. The next one is what I call these bankruptcies, reorganizations, public LBOs, special situations, kind of a catch-all. And many of you may be familiar with Sam Zell. Can you raise your hand if you've heard of Sam Zell? Okay, so a few of you heard of Sam Zell. Maybe you can Google him after the class. And Arvind, there's no downside to sending Sam an email asking him to speak to your class, because all that can happen is he can say no. But Sam is also known as the grave dancer, because he loves to dance on the grave of companies left for dead. And he's done really well. I mean, he set up equity office properties, equity residential properties. He sold a lot of these assets pretty much at 11:55 p.m. before the music stopped, and has done really well. But anyway, there are some investors in the U.S. who have been truly exceptional at the U.S. tax code. So, for example, Warren Buffett, in my opinion, knows the U.S. tax code almost better than anyone else. The Pritzkers, Jay Pritzker, who's passed away, knew the U.S. tax code really well. And I would say Sam Zell and the Lucadia guys, the Lucadia guys, I don't think they ever sent a check to the IRS. The Lucadia guys knew the U.S. tax code really well. And Sam Zell is a master of the U.S. tax code, really, really smart about the taxes. And you'll notice that there's a conspicuous person I left out of the list of people who know the tax code so well. And I don't put the Donald in the category of knowing the tax code so well. He may know a lot of other things so well, but I don't think he's that great on the tax code. I think he's okay. But anyway, Sam is an expert on the tax code. So in 1990, there was a insurance company that went bankrupt, Mission Insurance. And when they went bankrupt, the shell company was left, and the shell company had $650 million in NOLs, which are quite valuable. If you could marry those NOLs with a profitable business, you could shield the profits of the business for a while. And Sam was able to buy the NOLs for $30 million. So he went in and bought the bankrupt Mission Insurance, renamed it Danielson Holdings, and then Marty Whitman bought a stake in that too. So Danielson Holdings was an interesting business because it had Marty Whitman was the chairman for a while, and Sam was a large shareholder. And then they went hunting to find a profitable business that they could marry to this NOL-rich company. And they found a barge company in Mississippi. And this barge company was a profitable company, kind of transporting goods up and down the Mississippi. So they bought the barge company with the idea that the earnings from the barge company would now be tax-free for a while. And right after they bought the barge company, the barge shipping rates collapsed, and the barge company went bankrupt. And so now they had bankruptcy to the power of bankruptcy. And you will learn many things from Arvind, but he'll never explain to you how to calculate bankruptcy to the power of bankruptcy. All I can tell you, it's bad. Okay, so the 650 million of NOLs were now at 850 millions of NOLs. So they were in a deeper hole than when they had started. So now they went hunting for another business which would be profitable, and they could again do this. So they kind of were hunting around, and this time they found an unusual business. It was a waste to energy business. So this was a company that had assets worth 2 billion. They had debt worth 2 billion. And what they did was they had a bunch of plants where you put garbage in on one end and you got electricity in on the other end. It was a German process where they ran furnaces at very high temperature. And because your garbage has all kinds of things that have energy value, when you burn it, you create energy. And they converted that energy to electricity, and then they sold that electricity. And in some cases, they had long-term contracts to sell the electricity. So they had some stability of cash flows. And they had variance on tipping fees, which is what they had to pay to get the garbage, or what they got paid to take the garbage in some cases. And so they bought this company, and this time they hit it correctly. And so by the time the stock was at $1, by the time I found out about, and I think Covanta, they named Danielson Holdings Covanta. So you can see that in 2002 and 2003, this thing is trading at like $1 a share. And by the time I got to know that there was Marty Whitman, Sam Zell, and all that doing this, and they were planning to do a couple of rights issues and so on, the stock was at about $9 a share. And it was still cheap because of all the leverage and the NOLs and all that. And they did 2 rights offerings, which I participated in, and eventually I sold in about 18 months for about a 90% gain. And if I had kept it throughout, I think I would have had a 4x gain, if you will. So that's another one of these kind of these bankruptcy reorgs can have some unusual dynamics worth paying attention to. And then the final category, which is the upside without downside type businesses. So these are ones where a really good example of this is Silicon Valley Bank, and that is slide 17, the last slide. And so when I was starting Pabrai Funds in '99, the internet bubble was on, and all these stocks were climbing, pets.com and all of that. And I was trying to find a way I could play the bubble without any risk, because I knew some of the companies might do really well, but a lot of them may not do well. So I was trying to figure out a way to play it. And I had figured it out in my personal portfolio a while back with CMGI, which was 100x. But by the time Pabrai Fund started, CMGI had already climbed to some ridiculous number. So that wasn't really an option. But I found this bank in Silicon Valley Bank. And what Silicon Valley Bank did was they primarily had banking relationships with venture-backed startups. And so they knew all these venture capitalists, and the venture capitalists, when they funded companies, they would tell their founders, set up the account at Silicon Valley Bank. And they used to make, kind of asset-backed loans and different things to these banks. And anytime they did any kind of credit facilities or anything for them, they would take warrants. So, Silicon Valley is a place where if you're a landscaper for Google, you get warrants. If you're a chef for Google, you get warrants. If you're a waiter at a restaurant, just in Palo Alto, you'll get warrants for serving some venture capitalists. Warrants and stock options in Silicon Valley is like breathing. So they hand them out to anyone who has a pulse. And so the bank, when they said, okay, when we do our loans, we want warrants, the companies really didn't care. They said, fine, we'll give you, besides the loan terms, we'll give you some warrants. So each time they did a deal, they would have these warrants, and they had no disclosure on the warrants. So they just disclosed that they had the practice of taking warrants. So I had a sense of the companies that they had in their portfolio, because you could see some disclosure of some of the businesses they were doing business with and all of that, and they talked about some of these businesses. And so I said, okay, the bank is trading at a modest premium to book value. It's a well-run bank. It's actually been a well-run bank throughout. And we've got this unknown moonshot, possible moonshot in the warrants. So I said, this is something where I've got a floor because I'm not paying for those warrants, but the warrants could be valuable. And so as the bubble took off, and these companies started going public, the bank realized they were sitting on huge numbers in terms of values of these warrants, and they started selling the warrants because they wanted to monetize them. And so those now started showing up on the income statement, and then they were talking a bit about them, and the market finally understood, and eventually it became a 4x from where I was buying. I was buying in the $10-12 range. I captured about a 2.5x and moved on in about not that long a period. I think about 2.5 years. But I could have held on for longer and done even better. And so that's the fifth one. And CMGI, which we talked about at the beginning, was similar in the sense that those businesses had that attribute. And of course, I think it's not the most elegant way to make money. And probably in hindsight, I probably should have sold CMGI sooner, and probably should have sold even Satyam computers sooner. But I should have sold many of these other ones much later. And so we win some and lose some. And so that's pretty much the framework. And we've taken up, I think, Arvind, we've taken up we've got about 45, 50 minutes or so.
Right. We have about an hour. Yeah. Slightly under an hour left, about 50 minutes for Q&A.
Yeah,
but that was fantastic, Mohnish. So thank you.
Yeah, and I should thank you because, like I said, I found the one shipping company because I was doing this tour, and who knows what else I'll find.
Yes, I'm excited. So I don't know who wants to ask the first question, but please feel free. Maybe I'll start in the interim, Mohnish, which is, you talk a lot about cloning in terms of 13Fs and the like. How do you go about cloning international investments, given that there are no 13Fs for some of the areas that you traffic in?
Yeah, the international investments, you can get a little bit of that through Bloomberg. So it's not for Joe Public, because Joe Public will have a little harder time. But actually, not even Bloomberg. The thing is that if you if you go to a website in India like Money Control, which is like Google Finance, if you will, and India requires the brokers to disclose anyone who owns more than 1% of a public company. So the companies don't have to make a disclosure till they own 5% or something, but the brokers do. And so if you look at a specific company, you can see who the shareholders are. And there are some service providers and kind of data scrapers who like, I think I subscribe to one. I think it's called Alpha Ideas in India, which basically figures out who owns more than 1% of these different companies, and they update that once a quarter. So I can see some of that. Bloomberg also, like, for example, if I look at a Korean company in Bloomberg, it will show me the shareholders. And again, it's not as easy as a 13F in the US. But I think some of it you can get that way, but it's not the easiest thing in the world. I have found investments in places like Korea, which are owned by some investors I really admire a lot, and in China and such, through that process. So it does work.
Yeah, thank you very much for sharing time with us today. This is a fantastic opportunity. Really appreciate it. Wanted to touch on Tesoro that you were talking about. And you mentioned how they have kind of a moat on their supply in terms of refineries, and also though how you want to hold them for a long period of time. So I'm somewhat familiar with the industry, and people are saying that in the long run, there's going to be declining demand for crude oil. So when thinking about the moat on the demand side, if you will, how do you incorporate that into your analysis?
Yeah, that's a good question. You know, the Tesoro investment, at the time I had made it. I mean, this was a long time ago. I think that this was the investment in 2002, and Elon was still busy with other things at the time, and we didn't have any concerns on decline in crude consumption, if you will, as we do today. So clearly, if I were looking at the business today as opposed to 2002, you'd have to weigh that factor. And you know, the funny thing is that this is something that I've questioned, is that whenever I listen to kind of oil analysts and different people in the oil industry, they don't seem to really see the supposedly huge decline that may come in crude consumption from the switch to electrified cars, if you will. And I think the movement towards electrified cars is a real movement. I mean, it's you know, it's going to be a mix of hybrids and pure electrics and everything in between. But clearly, that trend is happening. It's also going to take some time because the economics are still not completely there. And you know, we have some economics in the U.S. on electric cars, but in other parts of the world, especially when you don't have garages and don't have your own private parking spot and all those sorts of things, charging becomes a real issue. And so in many parts of the world, including in dense urban areas in the US, that's a real issue. So I haven't had any investments where I've had to figure out, you know, what exactly is the trajectory of oil consumption. But I would say that yes, you'd have to factor that in. But if you got to extreme distress, I mean, if you take a period from 2016 to 2025, let's say you take that 9-year, 10-year period, it is not obvious to me that in 2025 human crude oil consumption is less than 2016. That is not an obvious statement to me. It's also not obvious to me that will grow over that period. But whether it will shrink over that period is questionable. And one of the reasons it's questionable is because large parts of the world, humans just don't have good transport options. And those are improving. And actually, if you think about the kind of the Ubers and Lyfts of the world, if you will, and all the different ways you get into mobility and shared economy and all of that, miles traveled in motorized transport per human is on a significant upward trajectory. So whether people own their cars or they lease their cars or they rent them by the day or the hour or by the ride or whatever else to do, or shared rides, the miles traveled is going up. And so it is obvious to me, there are some plays that are obvious. For example, it is obvious to me that tire consumption is going to increase. So if you ask me about total volume of tires produced in 2016, and total volumes of tires produced in 2025, there is no question in my mind that in 2025, that number may be 20, 30, 40% higher than it is today. I cannot make the same statement about crude oil. It may flatline, it may go down a little bit, it may even go up a little bit. We don't know. But the good news about this business is that we don't need to know everything about everything. And we can say no to a lot of things. And so anytime you encounter something which is giving you trouble, Warren Buffett has a real, people have an inbox and outbox on their desk. On his desk, he's got a real too hard pile box. And it's actually a box which says too hard. And one time I was visiting his office and he was giving me a tour of his private office. And I saw that there's a real too hard box there and it was empty. And so I told Warren, I said, Warren, you always said that like 98% of the stuff that shows up on your desk is in the too hard pile, but the too hard pile is empty. So what's going on? So he said, oh, let me fix that right now, Mohnish. And he immediately took a whole bunch of paper and he dumped it into the too hard pile. He said, does it look like most of it is rejected now? I said, yeah. I said, it looks great now. He said, okay, good. And then we took a picture with the filled up too hard pile box. So bottom line is that we don't need to have an opinion or a position about anything. What we want to do is we want to have opinions on high probability events, what we perceive as high probability events, where we think that we've got the odds in our favor. So like for me, when some analyst says Fiat Chrysler is going to produce 3 billion in EBIT, and my man crush Sergio says we're going to produce 9 billion, I go with the man crush, and so we just go with high probability bets.
Yeah.
So to go to one of the specific examples, you mentioned your thesis with Frontline was that you thought there was a liquidation value of like around $9 a share, and that you sold when you got to around there. In mentioning that you should have waited longer, right? Was your process wrong? Because you sold at what you thought was intrinsic value to a certain degree. So you mentioned humans sort of vacillate between fear and greed. How do you avoid that in your own decision making?
Yeah, I think that's a really good question because this is oh good, Arvind has muted, which is great. Because this is actually happening right now in real time. So there is Frontline 2.0, another company which just showed up on the radar, which shall go unnamed so you guys don't drive up the price. But Frontline 2.0 is basically a situation where it's trading currently, and I'm still doing the research. I'm hoping this weekend to really get my teeth into it. It seems to be trading at half of liquidation value, very similar to Frontline. All the debt is at the individual ship level and such. So it's trading at less than half. The rates and the utilizations have kind of gone down, which is what the market's concerned with. And the price has gone down like 70% 80% in the last year or two. And so clearly it's if after I do my analysis, I get comfort that something that's, let's say for argument's sake, is trading at $20 a share, and let's say it's worth 40, the liquidation value is 40. So clearly I don't need to make a decision today about when I would sell. I know that I'm going to sell at 40 or above, right? So I don't need to make that decision today. I've got time. I might have a year or two to figure that out and do more work to figure that out, which is good. But what I will not do, which I did with Frontline, is I will not sell at 90% of 40. With Frontline, I was very clear, 90% of liquidation value, I was out of there. I didn't want that anything more to do with it because I think I had a juvenile understanding of the huge swings in human nature and all of that. And so now that the benevolent gods of investing are giving me another crack at the apple, I'll try not to disappoint them this time. And so I'll figure out a few things. I could do something like cut my position in half, take half the money off the table, for example. I could do that, which is I would have gotten all my principal out, if you will. If I invested, 20 million and it's gone to 40 million, I could pull 20 million out and then say, okay, now let's let humanity do whatever it wants, and when we can't lose money because that's one way I could skin it. Or another way I could skin it is to let it go a little further, which is look at what's going on with the business at the time and try to understand some more about the dynamics and see whether it's a high probability that this can, that this can go to 1.5 times liquidation value or something or not. So we don't need to make that decision today. I think if you put a gun to my head and said, make the decision today, I would probably take the approach of something along what I said, which is take the principal out, leave the rest, but leave the rest again with a taper, in the sense that the next double, take another half off, and the next, because this is not Coke. We know this is not Coke. We know this is not Moody's. We know it's going to crash and burn one day. We know that. And it may take 5 years before it crashes and burns. But we don't want to be there for 4.5 years thinking it'll go for 5 years. So if we get our double, we might do it that way.
Yeah.
Yeah, so let's say if you do have a stock that you believe is like a Coke or a Moody's, at what point is that worth selling? If it's 100x, 150x, like when do you feel comfortable and how?
That is a really good question. And the reason it's a good question is because I think in the past I've not been good about that. And I think the thing is that there is an asymmetry. There is an asymmetry that I've had a hard time understanding. And, someone like Tom Russo understands this really well. Someone like Tom Gaynor understands it really well. Even someone like Charlie Munger and Warren Buffett understand this really well. And but I think like, for example, with Tom, Tom is always buying companies that are either number one or number two on our list. Either they can be run by idiots or they have great moats that need non-idiots. I've never seen things in his portfolio which go to number 3, 4, or 5. They're always number one or number two, right? So he's always playing in the number one, number two space, which is a great place to play. The only critique I would have, if I would critique something about Tom, is that there hasn't been, in my opinion, the level of price discipline in buying as perhaps might be better to have. So, there's this story about the difference between Ben Graham and Charlie Munger. So Ben Graham will go into a grocery store and he'll look for what item is discounted the most, and he'll buy that item and come out. And Charlie Munger will go into a grocery store and look for items that he truly loves. And then he'll keep going back every day till it goes on sale. And then when it's on sale, he'll buy that and come out. And clearly the Charlie Munger approach, in my opinion, is a better approach. Sometimes some people have taken the approach of just going in the grocery store and buying what they love, regardless of price or without too much attention being paid to price, where even a nearly fully priced is okay. And that can work out fine. I mean, you could have bought Crystal at a full price 20 years ago and still done well. So clearly with some of these incredible moats, you can do really well even at full price. I have a hard time with that. I think that is something I'm probably never been. That's a bridge I'll probably never be able to cross. But what I believe I can cross is I can identify these assets. I mean, I have a company in my portfolio today, which is like Coke. I never thought that would happen, but I have a company like Coke. This is a company that can be run by idiots. I never thought it would happen. I actually have a business that can be run by idiots. Awesome. And it's number one. It's like one of those absolute number one companies. Almost impossible to destroy the business. Almost impossible to destroy the moat. I believe that moat will be around 100 years from now. it may be around 300 years from now. It is super, super powerful in terms of the quality of the moat. I have decided that for that one business, I'm just never selling that, okay? Because I've never had the good fortune of such things happening. So I'll leave that one alone, and I'll play my Mickey Mouse games with the shipping companies and all this other stuff, and deal with it that way and leave that one alone. So to answer your question, I would just say this, that if you're able to get a Coke for 14 times earnings, my 2 cents to you is, Warren says that he made a mistake in hindsight of not selling Coke in 99 or 2000. So if Berkshire, 99, 2000, Coke was selling at 40 times earnings, and then that multiple dropped very significantly to less than half of that, and they never sold. And he said it was probably a mistake not to sell. And but the reality is the action that he took was not to sell. I don't believe Coke is going to be sold by Berkshire in either of their lifetimes. And I don't believe Coke will be sold by their successors for maybe a decade or more after they've gone. So Berkshire may be holding Coke for at least, let's say, 2 or 3 more decades, or even beyond that. And quite frankly, that may be a wise decision, because how many businesses can you identify that are like that? I mean, Coke is not even about sugared water. If you look at their portfolio of the 100 plus brands they have, and how many of those brands have anything to do with sugar, I mean, that number is going down. So actually, when people think of Coke, they think of the sugared water product. They have a zillion other products, and they have the distribution engine and all the different economics that make it such a great business. So my 2 cents to you is that if you are able to buy these type 1 businesses at a modest multiple, probably really good things will happen to you. I mean, let me put it this way. I think the business that I bought, I would say that if I got to a 50x on it, which may or may not happen in my lifetime, I might sell. I don't think I'm selling at 10x.
Other questions? Yeah.
In watching your previous videos, you talked a lot about your circle of competence, and I realized that I didn't know what my circle of competence was. So how would you recommend we either discover that or develop that?
I'll just give you Charlie Munger's question. Charlie Munger's answer to that question, which is to ask the question is to answer it. If you are wondering if something is in your circle of competence, it is not in your circle of competence. So it's as simple as that.
Other questions? Say.
Kind of piggybacking off of that, one of the companies, or 2 of the companies that you mentioned you missed on, Apple and Amazon, you mentioned were out of your circle of competence as well. And I was wondering what exactly about those companies kind of made you uncertain about your understanding of them, because it seems that you're pretty well knowledged in tech in general.
Yeah, I mean, I think Apple is I have a very good friend of mine who's a venture capitalist in Silicon Valley, and right after the first iPhone came out, he called me and we had a long conversation, and he's an investor in my fund, and he told me that I needed to buy Apple in Pabrai funds. This was, I think, in 2007. And he told me and tried to explain to me the App Store and what that meant, and kind of where this was going with the App Store and the ecosystem. And he also tried to explain to me. Actually, it was one of the most eloquent discussions I had with anyone about why to invest in Apple. And he highlighted the moat, but he also highlighted the fact that one of the things, put a pretty powerful computer in each of our palms, and he thought that that was a very significant game changer. And this was in 2007. It was well before Uber came out. It was well before a lot of other companies came out, and a lot of these companies could not exist if the iPhone did not exist. I mean, you just wouldn't have Uber if you didn't have an iPhone. It's just not possible to do it without a smartphone. And so it basically became the infrastructure on which everything got built. But I'm one of these stupid people that when people hit me with a 2x4 in my head with a great idea, I'm still not able to see it. And somehow we still limp along and do okay. And Arvind still wants me to talk to you guys. So I looked at Apple at the time. It wasn't at a single digit PE. The moment something's not a single digit PE, I'm gone. You already lost me. The moment you get to something at 11 times earnings or something, I'm lost. So clearly, I did not appreciate. I mean, I understood what he was saying, but I didn't want to pay up. I wanted a lot cheaper price to get a business like that. But even then, I've always been skeptical. And even today, if you look at Apple today, forget 2007. Let's look at 2016. So Apple trades at a pretty modest multiple. If you look at their earnings stream versus the market cap, it's very different from Amazon and Facebook. I mean, it actually produces massive earnings, and it's trading at less than, after you take out the cash, I don't know, I think less than 12 or 13 times earnings. I think Arvind may have the exact number. And that's not a high multiple for a business like that. But, I also play back in my head the graveyard of companies and technology like BlackBerry and Nokia and all these other ones that have had huge runs and disappeared. And Apple has something more than those companies have, because they have the App Store and they have habits. The important thing, this is what my friend in 2007 was saying, Mohnish, human habits are changing with the iPhone. And you have to understand when the habits change, that is very enduring. It was a great talk. I wish I had recorded that talk, because if I could play it for you, it'd be better than me babbling here. And so he was telling me about it's the habit economy, and all these habits were very important. And I didn't appreciate that. And so today we have a situation where Apple's, I think, unit sales are dropping, but their earnings are still rising. And because the ecosystem just gets larger, there's over 1 billion devices which have apps on them. And every quarter, the number of devices that have apps on them increases, even if their quarter-over-quarter sales decline. And of course, they got a free tailwind from the woos of Samsung, if you will. But my take is that this is one of those things where you want absolute no-brainers, and anytime in the investing world you have doubts in your head, then you're better off just not going there. So, for example, for me, drilling into the shipping company half off is a lot more tangible to get comfort than I could get with Apple at 12 times earnings today. It's just, and that may be a mistake, but it's just the way I'm wired. And so someone else can hopefully figure that out and do better with it.
Other questions? Yeah.
And of course, since that time, my venture friend sprinkles salt on wounds and reminds me what his Apple position is worth versus what his Pabrai fund's position is worth.
So, I have a question that's kind of actually the two questions in Tech 45. You explained how you evolve and how you really tailor your insight, and then you also also you shared us that there are some of the stocks that you actually experience the holes. And in coming of the 22 years, what contributed most in developing your general insight and your character in bearing those holes?
So the question, Mohnish, was how did you, over the past 22 years, how did you develop your insights and the character to survive the valleys of the holds? Is that right?
Okay, so it's about overcoming adversity. Is that what the question's about?
As well as how you develop the insights to build your circle of competence and to make those big bets that led to your success.
Yeah, I mean, I think the thing is that the first question to ask yourself is, what are you passionate about? You know, and if you're willing to work at something where the amount you get paid is irrelevant, and you truly enjoy that work, then you're getting close to answering the question correctly. And so if you are pursuing a career as a investment manager and investment analyst, and you would do this job if it paid the same as a school teacher, for example, then you are picking the right calling, because you should not be picking this calling because it pays well. You should be picking this calling because it is what you believe you're wired for and what you love doing. So the first question to ask yourself is, what do you love doing? And in my case, I think this is, I've asked myself the question repeatedly. In fact, one of the things that I had gone through in actually the '99 timeframe was, I'm part of this group called YPO, and we had done kind of an exercise where we had a couple of industrial psychologists who spent some time doing a 360 analysis of us. So they called and interviewed our spouses, our friends, in my case, people who work for me. If the kids were old enough to talk to the kids, then they conducted a bunch of tests on us. Then they interviewed us, and then what they gave us at the end of all of that was a blueprint of who we were. And what happens with most humans is that we have a map, kind of this is what we are on the inside, and then we kind of act this way on the outside because we believe the world expects us to act this way. But our internal wiring is that this is who we are, and we act this way. So if you get an incongruence between who you are internally and who you are acting like externally, you will not go far in life. What you have to do is you have to get things in perfect alignment like this, where your internal wiring is exactly the way you are externally. And so at the time I had gone through this testing, I was just about to start Pabrai Funds, and I was running a company which had about 170 people, IT company that I had founded. And the psychologists basically said that they couldn't even understand how I was able to run that company because it was so far away from what my preferences and competence and wiring was, if you will. And then they looked at Pabrai Funds, and they looked at kind of the way it would be and the size where there would be no people and all that. And they said, this is perfect for what your internal wiring is. So their belief system was that between our genetics and the experiences we have in the first 5 years of life, who we are as people is hard-coded. And that is not going to change for the rest of your life. So whatever wiring and kind of inside map you have is fixed. The problem is that most humans don't know what that map is because we don't come with an owner's manual. But at the age of 34, I received an owner's manual, a 20-page document. For the first time, someone gave me an owner's manual. It was invaluable. I thought it was one of the best things I ever did. The best $2,000 I ever spent. And that So one of these two psychologists, when Pabrai Funds was starting, he wasn't a very wealthy man, uh, but he invested. He was one of the original investors who invested. And I asked him, why do you want to invest in this? He said, Monish, I cracked your brain open. I know exactly what's in there. This is the right place to put the money. I know this bet won't fail, and of course we did quite well with that. So the first question is, if investing puts you in an alignment like this, which is not an easy thing to figure out, you can understand what some of these kind of things are in your owner's manual with how you feel after doing certain tasks. If you feel energized and excited about doing something, then you're in the right place. Like, the shipping company this weekend, if my wife told me we have to go to some party, I would prefer looking at the shipping company to going to the party. It would just be more fun and fun. So you can answer that question with kind of your likes and dislikes. So that's the first thing. You have to make sure that you are playing in center court of what you are wired to do. And figuring out what you're wired to do is not the easiest thing in the world, but it can be done. And you can, Myers-Briggs might help you. That's a poor man's version. But I think going to industrial psychologists like the one I went to, and they have tools to figure this out for you. And I think it should be required for every human. I think every human should have an owner's manual. It would really help a lot. The second part about the adversity and the valleys, there have been a few valleys. And, the thing is that there's a movie that came out a while back. I think it was a best picture of the year, Life is Beautiful. Did you guys see that movie? Raise your hand if you've seen that movie. A couple of souls have seen the movie, and a couple of souls think they may have seen it. Well, it might be useful to see it. It's in some parts funny, but I think it's got some great life lessons. So there are two movies. Books are so boring, but movies are more fun to see. So I'd like to recommend a couple of movies to you. The first one is Jiro Dreams of Sushi. How many of you have seen that movie, Jiro Dreams of Sushi? Oh, we got a few people who've seen that. That's great. So that's Jiro, who is my hero, is exactly like this. He didn't go to an industrial psychologist, but he is dead on doing what he loves to do. And it's a great movie. In fact, I have my first trip to Japan coming up next March, and it's a restaurant where they serve sushi. And I think you're going to make a reservation a month in advance. So I'm looking forward to meeting Jiro and eating his sushi in a few months. It'll be great. And so that's a great movie. The second one is Life is Beautiful, which is also a good movie to see. But the thing is that when I was, the Life is Beautiful will kind of, anytime you feel that you're in a valley or life is useless, put on that movie. It'll give you some perspective and such. And I saw my parents go through multiple bankruptcies in my childhood, and my parents were very poor financial planners. So when they were kind of like these Greek ship owners. When times were going well, we lived really well. And when times were rough, we didn't have money for groceries. We didn't have money for rent. It was absolute rock bottom. And so when the business, my dad was a kind of serial entrepreneur. So when the businesses went bankrupt, and every few years at some regularity they would go bankrupt, it would have a direct personal impact. Because just the basics were gone, and but through each of those bankruptcies, I never saw my parents ever get depressed. In fact, with my mother, I never ever saw that. In fact, she what I learned, one of the greatest things I learned from my mom was just the way she looked at life, just how resilient she was, and how resilient she still is, which is great. My dad would sometimes get down because there was just so much he was dealing with. And but one time, just to give you a quick story, I know Arvind thinks I'm taking up so much time with my stories, but just a quick story. One time my dad was bankrupt. There was nothing going on. There was hardly any money, and every Sunday he had this Hindu priest, show up at our house. And this Hindu priest claimed to be an astrologer who could predict the future. And he would, look at all these signs of when my father was born and Mars was in this position and all this sort of stuff, and say what was going to happen. And then my dad would pay him, and then he'd come back the next week again. And he's got all these markings on his head. He's got the saffron robes. And my dad was an engineer, and he wasn't a religious guy. So after I was like about 11 years old and got some courage, I told him, you gotta know that this guy is full of shit. Not in quite these many words, but in more diplomatic language, so I wouldn't get slapped or something. And I said, why do you have this guy? And he's taking money when money is very scarce. We don't have any money. So my dad says to me, I know he's full of shit, but I try not to think about that. So he says that I'm at the bottom of a well and I need a rope to climb out of the well. And he is my rope, because when I pay him and he gives me the future, he knows if he presents a bleak future, he won't be called back the next week. And so because he's going to give me a somewhat positive forecast about the future, I get some energy to kind of start climbing up that rope and try to get up and get out of the well. So my dad said, I'm paying him because he's my rope. So my dad figured out a way to find a rope, right? So one of the things, there are different, I would say there are different ways and different kinds of rope that you can use. So it is a given that part of the human condition is that we're going to have great times and we're going to have lousy times. And we're going to be, down and out at times, and we'll be riding various waves at times. And that's just going to happen to all of us. And the key is to understand that when you're down and out, just like the shipping rates that have collapsed, that it's a temporary condition. And the second thing to realize is, and this is, I'm not religious, but there's a Hindu philosophy that there is no suffering in this world. It's a Buddhist philosophy, actually. There's no suffering in this world. There is a reaction to events that humans have which causes suffering. So even if a person has cancer, and even if they are terminal, and let's say they're going to die in a month, at the particular moment that you ask them, so let's say they get a shot of morphine, they feel pretty good. So are they suffering at that moment? No, they're not suffering. 5 minutes later, are they suffering? No, they're not suffering. Now, if they think about the end terminal result, they will start suffering. So we have control over whether we suffer or not. The event does not cause the suffering. It is our reaction to the event that's going to lead to suffering. So if you can control the reaction, and that's why, like, if you see the movie like Life is Beautiful, he's controlling the reaction. So we have the power within us to control the reaction. And once you can understand how to control the reaction, then suffering becomes quite irrelevant. And so, the highs and lows, yes, we've had a few lows while I've been running Pabrai funds. But, then there's another saying, if wealth is lost, nothing is lost. If health is lost, something is lost. And if character is lost, everything is lost. So anything happening with Pabrai funds is only related to wealth. And so basically that is irrelevant. So it doesn't mean much. And so far in life, I thankfully have not had any health or character issues that are meaningful. So that's good. And I hope that continues. Sorry for the long discourse and getting away from value investing, Arvind, but you made me do it.
Mohnish, that was no, that was great. Other questions? Yeah.
So going back to the auto industry, like we've seen companies like GM and Ford, and I don't know, but they've had record profits, but the multiple keeps contracting. So do you have a catalyst in mind, or is this more of one of those bets where it's all upside and downside, you're really not going to lose anything?
Arvind, I missed the first part of the question. Can you just repeat it?
So the question was looking at businesses like GM and Ford, earnings have increased, but the multiple has compressed. And the question was, do you have a catalyst in mind when investing in those types of businesses? Is that a fair reflection?
Or is it just like
or is it upside downside focused, where you feel you can't lose any money and you can double or triple your money and you don't have a clear catalyst?
Yeah, well, so I didn't want to make this talk about stock tips and portfolio positions and such, but I'll try to answer your question in the context of just trying to be helpful. So the stock market is not there to instruct us. It is there to serve us, where we can buy at times when it's offering a bargain, and we can sell at times when it's euphoric. So that's the purpose of the stock market. So I never look at the GM or any other company stock price to instruct me on what the business is worth. What the business is worth is independent of that stock price. And catalyst, I have never done catalyst investing. So value is its own catalyst. So with GM, it's really quite simple. So recently I looked at if you go on the John Deere website, they have a investor presentation, and I think slide 49, if my memory serves me right, is a slide that shows 25 years history of their earnings over the last 25 years, 25 or 27 years. And they have the earnings in two pieces. One piece of their earnings is the earnings from their finance business, and the other piece of the earnings is the rest of the business. So a company like John Deere basically makes tractors and farm equipment, and they offer financing and leasing to their customers of that farm equipment. And the captive, so one of the mental models that I actually came to quite by accident, and I came to this mental model in 92. So it's been 24 years ago, even before Pabrai funds. And I won't go into the reasons why I came to that, because we want to keep on some type of schedule. But the captive finance businesses of companies like John Deere. So in 25 years, that business had seen a lot of cyclicality going up and down, and the profits had gone up and down. But their finance business had no cyclicality. The finance business of John Deere has made money every single year since 92, including the financial crisis, 2007, 2008, 2009, 2010, and even recently when demand for farm equipment has collapsed. And not only has it stayed profitable, it's almost stayed profitable in a straight line up, which means that almost always this year's earnings from finance are greater than last year's earnings from finance. And this is the case with almost all the captives. So if you look at Ford Credit and GM's captive finance arm, etc., these are very stable businesses. And they are more stable. So for example, banks during the financial crisis saw their earnings get whacked and a lot of losses and all of that. even during the financial crisis, the captive finance arms had no issues. And why is that? Why? So I'll get to the why is that later if Arvind permits me. Let's just take it to be the gospel truth that the finance arms of these captives go one way. So GM has a captive finance arm. So first of all, GM used to have a captive finance arm called GMAC. And what GMAC did is, before the financial crisis, instead of just financing cars, they started financing homes, and they started financing all kinds of things unrelated to cars or General Motors. After the company came out of bankruptcy, they started a new finance arm. They actually bought a subprime lender, and now about 1/3 of the North American business, when they sell a new car, about 1/3 of the time, if it's financed, maybe it's close to 40%, it's financed by General Motors Financial, GM Finance. And as they grow the sales, the earnings from that finance arm was going to keep going up. And just to give you a sense, Ford Motor Company used to make something like $5 billion a year on their finance arm. GM today makes about $1 billion a year on their finance arm. They have guided that in a few years it'll be at $2 billion. And if you understand the long history of how these finance arms go, if you take a very distant view of maybe 10 years, it may be 3, 4, 5 billion because they are still building out in other parts of the world, etc. So that finance arm is incredibly valuable. But let's say we just go with the 2 billion number, which the company expects to get to in their finance business in 2 or 3 years. So if you have a business which the cash flows are not like the shipping business, if the 2017 or 2018 cash flows from the finance business are 2 billion, and in 22 or 23 they are 2.5 or 3 billion, and they keep going, what is that business worth today? Well, that business in the low interest rate environment we're in today is on a bad day worth at least 15 times today's earnings. If it's a very, very good business. So if we think that in 2 or 3 years, GM's finance business, which is at $1 billion today, is at $2 billion, that business is worth $30 billion in 3 years. GM also has a business in China. They are the largest company that sells cars in China, and they sell it through a joint venture. So they sell more cars in China than they sell in the US, and they own half of those operations. And the Chinese operations, like clockwork, produce about 2 billion a year. They produce 2 billion a year for a while, and they continue to produce. And if anything, that number is going to go up. It probably goes up to 2.5 or 3 billion at some point. But let's keep it at 2 billion. So what is that business worth? It's in an emerging market. The Chinese are going to buy cars for a long time. There's a long runway ahead of the 1.4 billion, or whatever the population is, with cars being bought. It's 4 times the US population. Even with the lower GDP, it's still going to have a huge runway in terms of cars being sold. So we have these two businesses. They collectively, let's say in 3 years, are producing 4 billion. 4 billion in these two businesses, in my opinion, is worth at least 60 billion. It should be worth at least 15 times cash flows. And now the truck business in the US and Cadillac, and they've sell 10 million cars. I'm ignoring 7 out of those 10 million cars because I'm only accounted for Chinese car sales and the finance business. I'm ignoring part sales, which is also very high margin, and such. So I don't see how GM as a company is fairly valued at less than 50 billion with 20 billion of cash on their balance sheet when they have these two businesses. And I actually believe the truck business is worth something, and I believe Cadillac is worth something, and I believe at some point they will make money in Europe, and at some point they'll make money in Latin America, and so on. So that's why we invested in GM.
Mohnish, you've been so generous with your time today. I'm curious if you have any parting thoughts for the class as we kind of reach the last few minutes.
Well, this was a lot of fun. It actually went by a lot faster than I thought. I think my analysis of the 5 points took a little longer, so I'm sorry about that. But it was always, Arvind, it's always a pleasure. You always have great students. I love Boston College, and wish you all the best. And I hope you got something out of it. Thank you.
We did. This was great, Mohnish. Thank you so much.